So David is a CIO at Société Générale Private Wealth Management. Welcome.
Thank you.
And so you will talk about to give us a sort of macroeconomic overview just to depict the current situation.
Yeah, okay. Maybe I step up and go the other way, so I can also take a look at the slides as well. So I've got a few slides to share with you today, and I'll try to help you, find the right or the best asset allocation in for excess cash. We'll speak about a few things, but I think the things that at top of my head. The fact that central banks have become data dependent, we scratch our head with that, and it's becoming quite a lot of an issue. So some discussion on that, and also I'll try to give you a broad perspective of where we are, and try to guide you in terms of the outlook for inflation and rates as we can see it from now. So, but starting with this first slide here, everyone has the eyes focused on the Fed, and rightly so, because the Fed is our guide with regard to interest rates. It's been the case for many years. However, I think it's important to see here that actually, when you broaden out the scope, you see that rate cuts have already started. Interestingly, they have started first, as you can see. Does it work? Yeah, here. As you can see here, it actually started in emerging markets. So emerging market central banks were very, sharp and reacted very swiftly to the rise in inflation. And at the very beginning, if you remember well, the Fed didn't believe inflation would spike. So, back in June 2021, the Fed, was mentioning that the spike in interest in inflation was a short-term phenomenon. And they got it wrong, meaning that today they failed to trust their own forecast, meaning that the only guidance that they give us is that they will be data dependent. So they have a reaction function against what they see in the market and in inflation, but they don't so much trust their forecast. Interestingly, you can see here that Switzerland, Sweden, and last week the Eurozone have cut rates very lately. So ahead of the Fed, it's most likely to us that the UK will cut ahead of the US as well. So potentially the US will be the last, large central bank to cut rates, maybe in September or even slightly after. But just keep in mind from this slide that the process has started and it's already well underway. Here, I wanted to show you that despite the fact that most countries have seen a spike in inflation, and especially the US and the Eurozone with similar timing. Actually, the underlying and the causes of the inflation spike are quite different. In the US, it's all about excess demand. So the growth was raging. Consumer demand was very strong for a long period of time, and it's created quite a lot of pressure on the supply, which was constrained. While in the Eurozone, most of the inflation has been explained by the energy crisis, and to a certain extent the effect, the lasting effect of COVID. But the situation is actually quite different. Now, when we look to the economy and the developed markets in particular, I think what has changed this year very clearly is the fact that the outlook in the Eurozone has firmed up. So it's a spring also for the Eurozone economy, and here definitely you can see with the PMIs that we've come back well above the 50 mark level, meaning that the Eurozone is back in expansion. And last week, not only the ECB did cut rate, but they also hiked inflation forecast for the year. But most notably, they hiked their growth forecast for the year by 30 basis points to shy of 1% growth for this year. So a pretty nice acceleration. Now, I think it's quite interesting when we move to the US. And you remember that last Friday, interest rates spiked markedly on the non-farm payrolls figures that were above expectation. However, I think when you take a step back and look at what is going on in the U.S. jobs market, you can see here that the normalization has started for quite some time already. So the job openings, which shows the tension in the U.S. job market, are well below trend at 8 million. And interestingly, what you can see here is that the quit rate, which correlates well with wage growth, is back to pre-COVID level at 3%. So we have in mind that although there are still a little bit of troubles in the data, the big and the longer time frame is the fact that the jobs market is gently normalizing, and so that's quite important because it means that it's very unlikely that we're going to see second round effect of inflation, which is probably the main risk for central banks. Now, last week we had obviously the first rate cut for the ECB. What you have here is the number of rate cuts that are penciled in for this year. And as you can see, we have round about 2 cuts to go for the end of the year, as it is forecasted. Now, I just wanted to highlight again the fact that central banks are overly speaking about the data dependency, meaning that they fail to trust their forecast, which is an issue for us on the investment side. The other thing that I wanted to share with you here, and I think it's specific to the Eurozone and to what happened recently with the weekend elections in European elections and the impact that we've seen on the French dissolution. What we see today is that the spreads are tightening. It's something that we've seen many times. Last time it was more centered to Italy, but here again we have a normal phase of tightening. Spread widening, in France and also in the very periphery. So what it produces is what the ECB calls an undue tightening of the financial conditions. So meaning that the ECB wants to reduce interest rates, but because of the market participant and the fear in the market, actually what you have is spreads widening, which create in retrospect a negative impact on growth. So it is likely that at some stage these 2 cuts could actually move, with the ECB judging that it has to ensure a nice and an even monetary policy. So it has, the ECB has developed more tools, but also they could very much change their view on rates if spreads continue. So that was probably the last message. Now, as you have seen since the start of the year, and it's the last slide, in retrospect, I mean, there's quite a lot of volatility on inflation forecast, and the market is quite skeptic on each and every inflation release. Tomorrow we have a new one with the US CPI, but also the market is quite skeptic on growth outlook. And it's interesting here that you see that these two are moving. Maybe what I could say is that when we look for this year, this year actually what happens is that all in all the disinflationary process continues. Disinflation continues, probably not at the pace that was expected at the beginning. But what has very much changed is that the growth outlook is much stronger. So it gives central bank quite a lot of leeway in cutting rates, so they don't have to rush to cut rates just because growth is accelerating. That's very much true in the US. Despite the revision, we have a GDP now at close to 3%. But it's also true to a certain extent in the Eurozone, where actually the growth environment has improved markedly, which is pushing a little bit the boundaries for the central banks. So that's. I think that is my closing remark. So potentially quite a lot of movements, and you can use this diagram here, to position, what is the best outcome. So potentially, if we are in a growth but disinflationary boom, it's interesting to lengthen a little bit the duration, so move out of money market funds into something a bit more, with a bit more duration. And I don't want to, open up to the solutions things, but what we find particularly attractive now with regard to duration is that when you consider extending duration a little bit from money market fund to short-term bond funds, actually you have quite a good asymmetry at the current stage, because the carry yield is so high that it pays off quite a lot for price movement on the securities portfolio. So potentially, while money market funds was the best solution during the rising yield phase, at this stage of flat to declining yields, probably moving to lengthen the duration, moving to short duration bonds is potentially more attractive from a total performance and also risk standpoint.
Thank you very much. So maybe a first question. So I understand from your presentation that diversification and a combination of different products, different tenors could be one of the solutions, because facing these uncertainties, it's really difficult to know what will be the right strategy. Even if we see a first start of cutting rate, we don't know what will be the pace, if the US will follow. And
that's what I mean, because when you look to actual data of short duration fixed income portfolio, and you look to the metrics, actually what I find attractive is that you don't have this similar mark-to-market evolution on the upside, on yields, and on the downside. So that's what we call the asymmetry. So meaning if yields go up a little bit or fall not as quick as expected, it will not affect the performance very significantly. While if yields realize much faster on the downside, the performance is going to be greatly improved. So that's why I think it makes quite a lot of sense. The carry return is very high, close to 4% on short duration bonds, meaning that each and every month you start the month with 35 bips of positive performance, and you have to, so that you are offset against positive or negative mark-to-market movement. So that's And
you talk about the first rate cut, but still interest rate remain quite high. You mentioned potentially 3 cuts, so 0.75% in Europe. In US, we even talk about potentially a further increase. So that will not be good for us, because it means that it will have a bigger differential of interest, so more interest for investing in US dollar, or what we call the imported inflation. So I'm also scared about the borrowers, not only the corporate borrowers, because we have a lot of companies having huge debt, and these high interests are penalizing them, And we have also the States. You mentioned France, but some other countries are in difficult situation where the debt is quite high. Not only Europe, by the way, the US is also in a difficult situation. So what is your view of the risk of default from both sides, corporate or state government?
Yeah, so I think there are quite a lot of questions in you know, within this one. But you know, starting with your first comment on you know, is it likely that we actually see a hike in the US interest rates? So our view it is mostly unlikely. And I think what we have to keep in mind is that you know, the state at which we are, 5.5% in the US, is well above inflation. So it's already, you know, the Fed, as it stands, is in a very restrictive, you know, environment. So you know, it's more a question of, you know, staying very restrictive for an unknown period, rather than become even more restrictive, which doesn't affect a lot. So I think it's more that question there. Now to your question on you know, the financial health, I think it's a key question, and especially when you consider diversifying out into corporate bonds, for instance. I think what investors sometimes fail to see is that the period that we've gone through is exceptional. Is exceptional in the sense that we had high real growth and high inflation, meaning that we had a period of very high nominal growth. So I've looked at it when you look at the average corporate in Europe. Their revenues have increased by 16% since 2020. 16%. And EBITDA have increased by almost a quarter. So while at the same time, debt level have remained you know, roughly stable, meaning that the financial metrics of most corporates have greatly improved. And interestingly, when you look to the European high-yield corporate segment, this year you have more upgrades than downgrades. So very little new comers in the market, but the ones that were in the market in 2020 have seen their financial metrics greatly improved. So that's a key benefit for the asset class. Now, moving on to government, it is to a certain extent similar. Governments have been running very high budget deficits, but those budget deficits so far have been paid off by very strong nominal growth. And nominal growth was actually higher than the budget deficit. In the US, 6-7% budget deficit last year, but nominal growth was closer to 10%. So actually the debt to GDP ratio didn't deteriorate that much. But now we are at the stage where, you know, you have to pay the bills. And so nominal growth has slowed significantly, not only because of inflation, but real growth is also slower. So meaning that, you know, government will have to, you know, to take the house in order and to start you know, tightening their belts as well.
Thank you very much. So,
welcome. Thank you.